Good morning. Today, we are initiating coverage on MongoDB, ticker symbol MDB, with a focus on its transition from a niche NoSQL provider to a foundational enterprise data platform. As we dissect the current valuation, we are looking at a company trading at a premium relative to the broader software infrastructure index, but justified by superior unit economics and a distinct competitive moat. Our analysis suggests that the market is currently underappreciating the long-term stickiness of the Atlas platform and the potential revenue acceleration derived from vector search workloads in generative AI applications. Over the next 12 minutes, we will unpack the revenue quality, margin expansion trajectory, and the specific valuation multiples that define our price target. To understand the valuation, we must quantify the moat. MongoDB's core differentiator is the document-based model, which allows for schema flexibility that legacy relational databases like Oracle cannot match with significant friction. This isn't just about developer convenience, it's an operational leverage story. By storing data in JSON-like documents, MDB reduces the impedance mismatch between application code and database storage. Institutional capital should focus on Atlas, their multi-cloud database as a service offering. Atlas now represents the majority of total revenue, shifting the model from term license volatility to a high-visibility, consumption-based recurring revenue stream, with net retention rates historically exceeding 120%. We define the total addressable market not just by the current NoSQL sector, but by the broader operational database market, which IDC projects to exceed $84 billion. MDB is aggressively capturing share from legacy providers. The key growth vector here is the workload shifts. We are seeing a structural migration where new enterprise applications, specifically those requiring real-time analytics and unstructured data, are defaulting to MongoDB. Furthermore, the integration of vector search allows MongoDB to act as long-term memory for large language models. This effectively expands their TAM into the AI infrastructure stack, a critical component for re-rating the stock's multiple in the coming quarters. Let's turn to the P&L. Top-line growth has shown resilience, but the mix is what matters. We are scrutinizing the deceleration in non-Atlas revenue versus the acceleration of Atlas consumption. Atlas is the bellwether. In recent quarters, we've observed Atlas growing at over 30% year-over-year, significantly outpacing the legacy server segments. Investors should model for some consumption volatility due to macro optimization, but the long-term CAGR remains intact. We are looking for revenue durability, and with over 45,000 customers, the diversification protects against single client concentration risk. The consumption model provides a real-time pulse on enterprise digital transformation activity. Historically, the bear case on MDB was cash burn. That narrative is dead. We are now seeing significant operating leverage materialize. Non-GAAP income from operations has turned positive, and we are modeling a steady march toward robust free cash flow margins. Gross margins have remained healthy, hovering in the 70–75% range, which is standard for high-value SaaS, though slightly compressed by the underlying cloud infrastructure costs of Atlas. The key metric to watch is sales and marketing efficiency. As the product-led growth, PLG, motion matures, S&M as a percentage of revenue should decline, driving bottom-line expansion. We project FCF margins stabilizing in the high teens within the next 24 months. We must address the elephant in the room: hyperscalers. AWS has DynamoDB, Microsoft Azure has Cosmos DB. These are formidable competitors because they are often good enough and integrated into existing cloud contracts. However, MongoDB's Run Anywhere value proposition prevents vendor lock-in, a major concern for CIOs today. While Snowflake and Datadog compete for wallet share in the broader data stack, they are largely complementary. The real threat is commoditization of NoSQL. Our channel checks indicate that for complex, mission-critical transactional workloads, MongoDB retains a significant feature lead over cloud-native clones. Valuation requires a relative assessment. We benchmark MDB against a high-growth infrastructure cohort, including Snowflake, Datadog, and Cloudflare. Currently, MDB trades at an EV to next 12-month sales multiple that demands execution perfection. If we assume a conservative 20% revenue growth decay curve, the stock appears fairly valued at current levels. However, if AI workloads re-accelerate growth back above 25–30%, multiple compression is unlikely. We utilize a sum-of-the-parts analysis, ascribing a higher multiple to the Atlas revenue stream compared to the legacy Enterprise Advanced segment. Our proprietary model suggests a premium is warranted due to the scarcity of independent database assets of this scale. The bull case relies on the AI supercycle. As enterprises build generative AI apps, they need a vector store. MongoDB Atlas Vector Search allows developers to build these apps on the same operational data layer they already use, reducing architectural complexity. If MDB captures even 10% of the vector database market, our revenue projections are too conservative. Additionally, the bull case assumes that the consumption slowdown seen in the post-COVID era is cyclical, not structural. As interest rates stabilize and enterprise IT budgets flush, a reversion to higher consumption growth rates would drive the stock significantly higher. Conversely, the bear case is grounded in valuation risk and competitive erosion. If enterprise cloud optimization, where companies aggressively cut data spend, becomes the new normal, MDB's net retention rate could dip below 115%, triggering a multiple derating. Furthermore, if Postgres-based open-source solutions utilizing extensions like PG Vector gain traction, MongoDB could find itself squeezed from the bottom end. There is also the risk of execution failure in the sales organization as they pivot from hunting new logos to farming consumption within existing accounts. A drop in growth below 15% would likely see the stock punished severely. In conclusion, we view MongoDB as a core holding for institutional technology portfolios, albeit with volatility. We are setting a 12-month price target based on a 14x EV sales multiple on FY26 estimates. The risk-reward is favorable for long-term horizons, provided the investor believes in the convergence of operational databases and AI workloads. We recommend accumulation on pullbacks, specifically monitoring the Atlas consumption growth metric as the primary buy-sell signal. MongoDB is not just a database. It is an index on the speed of modern software development. We rate MDB a long-term buy.